My name is Balaram Reddy. I am the founder and managing partner of Spectrum Group. So we are here for last 8 years, and we've been providing services on accounting, audit, value-added tax, corporate tax, now company incorporations, PRO services, and risk management services also. So along with me, I have my colleague, Mr. Manish. I'll let him introduce about himself. But before that, I have worked with various other Big Four auditing before, and I have about 20 years of work experience. And we conducted various sessions on value-added tax also earlier, as well as now on corporate tax at various forums. So once again, thank you all for joining this session. And we will be definitely trying our best to add value to your understanding of the corporate tax in UAE. And one thing which you need to keep in mind is that this is only a interpretation or explanation that we are giving on personal capacity. And if any specific question or any specific instance is there for which you may require any additional guidance and all, so we expect you to consider it only after having a formal understanding of the issue and then a response to that. So this is only for to help you in understanding the law a little bit more. But yes, so any advice that should be considered only after taking professional advice in written than having it in orally here. So, but yes, at the same time, we'll try to address your questions as much as possible, and that may be helpful for you to take it forward. So the primary source of reference for any of your law is the FTA website or Ministry of Finance website. That's the source that you need to check always to get to know the law and the further guidance on that. So these are only just to help you to understand the law a little bit more. So with this, I would like to hand it over to my colleague Manish to take it forward. Manish, over to you.
Good afternoon, everyone. Thank you, Balram, for the introduction about Spectrum and about yourself. Just to introduce myself, I'm Manish Saraf. I'm a chartered accountant. I've been working over the last 20 years with Big Four Consulting and then other consulting firm into audit and taxation jurisdiction. And today we are going to talk about the corporate tax as per the federal tax authorities, which have introduced in UAE. And you might have already been attended some of the sessions about it, but we'll try to elaborate on certain points which would be more practically applied to your business scenarios. So basically what we're going to cover in this is about the background in terms of taxability of the individual, the corporates, and then the group, how we can form a group, and if what are the qualifying group, and how the losses can be set off, carry forward, and what are the incomes which are basically exempt and allowed, disallowed expenditure, and then the qualifying free zone. That is the main focus of our presentation today as well. And what are the expenditures within connected persons and the business, and the administration procedure for the corporate tax. So in terms of the background, how if you see that over the last 5 years, the compliances in UAE has increased, and there is one like country by country reporting, which is for the multinational enterprise having revenue turnover globally more than 3.15 billion dirham. So they need to do this reporting. And then there is ESR, economic substance regulation, with respect to specific business activities. It could be investment, holding companies. There are certain other regulations which they need to file it, 6 monthly notification and annual reporting. Then value-added tax, you would all be familiar with it, where it is for the sales, tax on the sales, which we do. And then the anti-money laundering compliances for specific businesses, again, more to do with the banking, and then the gems and jewelry business houses. And then finally, we have this corporate tax, which got implemented from 1st June 2023, but we will see how this implementation is getting affected for different financial period. So why this corporate tax was introduced? Because until now UAE was considered as a tax haven, as the companies or the businesses were not paying any tax on the income they would generate. So most of the companies were shifting their business in UAE to avoid those taxes, and that was not being considered at par with the global economy. So to be at par and to be a transparent jurisdiction where the other geography regions can invest in UAE to not as seen as a tax haven. So that's the corporate tax what being introduced here. Now, if we look at as I was mentioning that different financial period will have a different implementation date. And so if a financial period beginning from 1st July 2023 to 30th June 2024 is the financial period. So for them, the corporate tax got implemented from 1st July 2023. And then there is annual return to be filed under the corporate tax. One annual return has to be filed. It is 9 months after the end of the financial period. So if you see end of the period is 30th June 2024, the 9 months thereafter is 31st March 2025. Whereas in the VAT, we file quarterly return, but in corporate tax, it is an annual return. And most of the financial period will begin from 1st January to 31st December 2024. So for them, the first financial period for corporate tax purpose will be 1st January 24 till December 24. And then the first annual return to be filed 9 months after the end of December is 30th September 2025. Just to know, as I'm reading out, I'm explaining about different slides. You can raise your queries in the chat box, and then at the end of the session, we will discuss on those queries, whatever you would have raised in that. So in terms of, if you see the geographical landscape in UAE, it is mainland, we have then free zone, and then there is an offshore. So there are around 40 to 45 free zones in UAE. So the treatment of corporate tax, businesses and in the free zone will be different than what they would be in the mainland. And offshore and free zone are considered to be the same treatment under the corporate tax purpose. And then we see that because there's a rate of tax is different. For the mainland entities, it is 9% on the business income. It will be taxed. Beyond, so the tax rate is 9% beyond the threshold of 375,000. They earn business income more than 375,000, then they pay tax on the above amount. So if it is more than 375, so if they are earning 350,000, so they will not be paying the tax. But if it is more than 375, then they end up paying tax on the income. And if you see the legal form, it is basically it is either a limited liability company, public shareholding company, which is a judicial person, whereas sole proprietorship, civil company, partnership, they are natural person. So this, the business is not different than what the individual who's running that firm business is. So it is the blue line are all the are called the natural persons, whereas the red one on the right side are the one which are the judicial person, because they have a different taxability in the corporate tax. So as I was mentioning, judicial person and natural person. So all the LLC companies, and those who are running freelancers or sole proprietorship business are under the natural person, and they could be either exempt or it could be taxable. So if we look at the natural person taxability, so the business income, if what are those incomes which natural person will not be taxable? Say if they are earning salary income, the wages, and even the bonus is being received as part of the salary, as part of the annual performance, will not be taxable in the hands of the individual. And if they also do a personal investment, it could be in the share market, the stock market, then that income earned out of the stock market will not be taxable in the hand of individual. And also the real estate income, which if the individual can own a real estate property or a apartment and earning rental income out of that, that rental income in the hands of individual will not be taxable, as those are the categories where individual might not be required to have a license to hold that particular unit. So those income earned out of rental will not be taxable in the hands, or if they even sell or buy a property, so any gain they arise out of it will also not be taxable. But other than these three categories, wages, personal investment, or real estate investment, any income and any businesses they perform will be taxable. So if a freelancer is doing a consulting activity or any other business activity of commercial nature, that become taxable. Now there is a threshold also for individual, like if it is like until 1 million, they will not be taxable. On the turnover of 1 million, they will not be taxable on the business income, on the individual capacity. And also that they need not be required to register for corporate tax. Only once their annual turnover is exceeding more than 1 million, then they would be required to register for corporate tax and pay the corporate tax liability. And so overall summary in terms of the taxable person, it could be either resident person or a non-resident person. A resident person could be incorporated in UAE. It could be either in the mainland or in the free zone. So these all become taxable, but the rate of tax would vary depend upon the kind of business activities being carried out in the free zone. And also it could be either incorporated outside UAE. So if a company is say is based out of UAE and has done some investments outside UAE in Europe or any other country, in India, any part of the world, and that is being controlled and managed, the owners are sitting out of UAE and making a decision for the business in Europe or the decision in India. So that being controlled out of UAE, then the income earned outside UAE for that business can also be taxable. And then in case of natural person, individual who conducts a business activity other than those three categories like wages, real estate, or personal investment income, that doesn't become taxable. But other than that, any kind of business activity is being carried out in UAE become taxable. And also it could be because for a natural person, they can also do a remote activity, sitting out of UAE, serving any part of the world. The income as a freelancer activity for any Europe client sitting in UAE, then income earned from UAE for the customers or client based out of Europe will also be taxable in UAE. And any other decision which the cabinet may come out with to include any specific category of person that become taxable. And non-resident, a person also having a permanent establishment in UAE. So permanent establishment is having a branch office or a subsidiary company in UAE will be taxable. Derives UAE source income. So it's basically when it derives UAE source income, that means is selling any garments or any trading activities in UAE and earning income from that sale in UAE, that become taxable, and having any nexus in the UAE. So cabinet will come out with time to time what kind of nexus. Recently they have mentioned about having an immovable property, non-resident having an immovable property in UAE, earning any income out of that become taxable in UAE, though he could be based out of Europe or India or any Asian continent, anywhere. So just to take up a detail for the non-resident person, now if it is a UAE source income not attributable to permanent establishment. Now, when it is not attributable to permanent establishment, that means he doesn't have any fixed establishment in UAE. Will it be still taxable? Yes, if it is derived from a person resident in UAE. So if he's deriving a person resident in UAE, that means he's selling those garments or trading in UAE, that income is become taxable. And also income from another non-resident paid attributable to the PE for that non-resident. That means there is a non-resident A of India and there is a non-resident B of India. And A doesn't have a permanent establishment, it doesn't have a branch in UAE, So but B, non-resident, is having a branch in UAE. So that B is having a permanent establishment. So A is selling anything, any trading activity, and electronic items or any garments to B, and B is further selling it to end retailer to end customers. So any income derived from A from B being a non-resident having a branch in UAE, that become taxable. And any other activity, it could be performed through asset being rented out or any capital invested in UAE, become taxable. And the second category is income attributable to PE. That means any kind of branch or any kind of setup in UAE, fixed setup in UAE, that becomes taxable. And third category is income attributable to Nexus. It could be in any form of source of income is in UAE, then it becomes taxable. So in terms of structure, if you see, I mean, the key takeaways from the basic fundamental requirement for the corporate tax is that we need to see the legal structure, what is the setup. It is a branch setup in UAE, or or it is in mainland, or it is in free zone. How is the setup being done? And the second point we need to look at is the financial period, as the financial period is crucial for the implementation of corporate tax. So if the financial period is beginning any period after 1st June 2023, so the corporate tax will be applicable for them. Or if you want to change the tax period also, if you have not clear about the financial period, you need to look at the memorandum of association, where your financial period would be mentioned. And then, there are certain, we need to see whether those businesses falls under exempted category or not, because those are related to government and natural resources. If your businesses falls under certain exempted category, then you may not be required to pay corporate tax. And need to see the setup in terms of whether we have a branch in outside UAE, the income earned outside UAE, well, whether it will be taxable in UAE or not, that need to be looked into it. So in terms of, we look at the tax group, how the tax group can be formed. Tax group can be only formed by the judicial resident person. So as I mentioned earlier, there are two categories. It is judicial person or a natural person. A judicial person who is like limited liability company or any kind of legal structure being formed for a company. Then those are the only one who can be able to form a tax group. And it can be formed only when the two companies are having 95% more than 95% ownership, common interest shareholding in between. So company A is there and LLC company A and LLC company B is there, and both of them are having a common 100% common or more than 95%. Then they can form a tax group. And then neither parent nor subsidiary should be exempt. So that means because as they would be paying tax on their income, they should be all falling under the corporate tax regulations. Then only they can form a group. Like if someone is in the qualifying free zone, because for qualifying free zone, there's a different tax rate, 0% or 9%, depending upon the business activities they're carrying out. So a mainland company cannot form a tax group with a qualifying free zone. Maybe it could be in a DAFZA or any other free zone, and a mainland company based out of a main part of the Dubai, it cannot form a tax group. And then the next criteria is they need to have a same financial period. That means January to December or whatever financial period is there, that need to be same, because that's how they will club the income for the same period. And then same accounting standard, which is basically IFRS, need to be followed. So now what is the implication of having a tax group? So they become a single taxable person. That means the basic exemption limit of 375,000, the threshold limit of 375,000 taxable income is common for all A and B together. So they will not benefit individually of the individual slab limit of 375,000, beyond which the 9% is taxable. So up to 375,000, it is 0% tax. And beyond 370,000 of income, 9% is paid. So that common slab will be applied to both A and B. And then the parent company will be the one who would be going to comply with all the regulations, documentation of CT registration. And then the consolidated financial statement has to be prepared. So the income, the revenue, the expenses, and the balance sheet has to be combined together while filing the tax return. And then parent and subsidiary shall be jointly liable for the tax liability. And then tax group shall cease to exist if they don't meet the criteria of forming a tax group, which is 95% common shareholding or any other criteria which are there. If they fail, then they cannot continue to form a tax group. And a parent company can be replaced by another. It might happen that some company X is taking over company A, who was a parent company earlier. So if a company X is taking over A, then X become a parent company and it can be forming a tax group with company B. Now, in case of qualifying group, so I mean, if someone is they're not able to form a tax group because common shareholding of 95% is required, even if they don't have a 95% common stake in between A and B, but it is less than 95%, but more than 75%, they can still form a qualifying group. So the qualifying group criteria remains the same. It's only that the percentage of stakeholding changes from 95% to 75% of common interest. And then the same criteria of exempt and qualifying free zone cannot be forming a tax group because the tax rate structure is different and same financial period and accounting standard to be followed. So now the provisions regarding the tax losses, I mean, if there are tax losses, how much it can be carried forward and to what extent it can be carried forward. So tax losses only from the period of which the corporate tax is implemented. So the corporate tax is implemented from 1st January 2024 for the financial period Jan to December. Then only the tax losses with respect to the period of January 2024 onwards, only the tax losses can be carry forward. So your losses prior to the implementation of the corporate tax cannot be carried forward. So 2023 period tax losses cannot be carried forward. It is from 2024, any tax losses incurred in that period can be deducted, offset against the future period. And the amount of tax losses which can be carried forward is 75%. And then, I mean, so we can look at it, what is that criteria example in this. So if suppose, if there is now tax losses of suppose in 2024 being the first period of corporate tax for Jan to December, and there is a loss of 275,000. So this loss of 275,000 can be carried forward to the future period. And 2025, suppose we have an income of 100,000. Out of 100,000, only 75%. To the extent of 75%, we can adjust our previous period losses. So in this case, 75,000 after 100,000, 75% is 75,000, and then out of 275,000 of previous year losses, if we set off the 75,000, then the loss carry forward is 200,000. So this 200,000 can be carried forward to 2026, and then if you see the income earned in 2026 is 1 million. And we had a loss of 200,000 carry forward, so it can be completely set off because 75% is 750,000. And so losses can be carried forward until indefinite period. So there is no time period defined, and you can carry forward for future period until your business is continuing. Now this is an example where it is a tax. I mean, it is a qualifying group. In case of qualifying group, how the tax losses can be set off against different company A and company B. It is like if a company A is earning revenue of 2 million and company B is earning a revenue of 3 million. Company A had a net loss of 550,000. This 550,000 can be set off from company B, and it can be set off up to 75% of the earning of the company B. So company B earning is 600,000. So 75% of that becomes 450,000 earning. 450,000 losses can be set off of the company A. So the balance remaining is out of 550,000, deducting 450,000 is 100,000. This 100,000 can be carried forward from future period. And the company B has a net earning after adjusting the set off of the losses is 150,000. So 600,000 minus 450,000, the balance remaining is 150,000, which is a net, and it is below the taxable limit of 375,000. It will be, so tax is 0%. So now there are certain exempted income, which is basically the first category is dividend. And dividend is something which is distributed after the taxable profit. So as the company has already paid a tax on their profit, so the dividend being distributed out of the profit, so it is not being taxed in the hands of individual who's receiving that dividend. So the owner who's withdrawing the profit from the company, which is tax paid and considered to be dividend, it will not be taxed in the hand of the owners. And then another is basically dividend and other profit distribution received from participating interest. Now, participating interest is where if the company A is based out of UAE, has invested in company B, company C in out of UAE, that is India, Europe, or any part of the world. If they have certain shareholding in outside UAE, and dividends are being received or profits are being received from that company B or C in other countries, then that is not taxable in UAE, provided it is participating interest. Now, the definition of participating interest is that they need to hold minimum 5% of that investment. The holdings should be more 5% of total shareholding outside UAE, and that should be holded minimum for 12 months. So any profit earned or capital gain on from that company outside UAE will not be taxable in UAE. And then the other category is that in case of non-resident having aircraft or international shipment transportation, that will also be income derived from that will not taxable because it is an international jurisdiction. And then foreign permanent establishment. So any person having permanent establishment outside UAE, that means having a branch or any kind of setup outside UAE, any income earned from there will not be taxable, provided there also the other country is also paying at least minimum 9% of corporate tax. So because they are already paying corporate tax outside UAE, then they may get an exemption, of income earned from that. The tax is already paid outside UAE, so it won't be taxed again in UAE. Now, the important topic is deductible expenditure. For your businesses, what are the expenditures which can be deductible? The first is that expenditure has to be incurred exclusively for the business, because generally it would happen that when you have a telephone expenditure or a vehicle expenditure, it could be for portion of it can be used for the business and portion of it can be used for private purpose. So that has to be categorized. Similarly for telephone also, those expenditure has to be categorized that what portion is attributable to the business. And it should not be in capital nature. Capital nature is basically you are buying a car or any kind of asset for the company. That whole amount cannot be claimed as an expenditure because capital expenditure are being allowed as a depreciation expenditure. So amount paid for 50,000 dirham is being paid for buying a car, then that amount is not deductible. It will be allowed as a deduction as a depreciation expenditure. Then this should not be related to exempt income. So exempt income is basically dividend, and also if you if you have invested in a shareholding of any company, but you would have borrowed that fund to invest. So the interest amount on investing that funds in another company will not be deductible because the dividend earned is not taxable in the hands of the recipient. And any other expenditure, which is basically specified by time to time will not be deductible. And the most important is it is incurred in the tax period. So if your tax period is starting from 1st January 2024 onwards, January 24 to December 24, so that it will be only those expenditure pertaining to that period. And it will not be like expenditure being incurred in 2023 will be allowed in 24, because there could be cases, that by the end of the year, there's certain expenditure being incurred in October 23 or November 23, but they are being paid in 2024. So the payment of those expenditure in 2024 will not allow you to claim that expenditure in 24 because these are pertaining to the period of 23. So that need to be taken care of in transition while implementing the corporate tax. And then certain expenditures which are not deductible is donations. Donations being contributed other than the qualifying public benefit entities. These are the non-profit organizations with the government time to time release a list. And if we donate in those non-profit organization which is listed by the public circulation, then those are allowed as an expenditure. But other than that, any donation, grants, gift, given will not be allowed. And also input VAT not claimed, input VAT which is not claimed, which are claimable, like, if your expenditure, this could be small amounts, could be relating to your telephone bills or fuel bills. There are inputs VAT or there, which we might not be tracking it because of a small amount, but we need to start tracking it so that we can claim out from your output tax. If we don't claim that, then we cannot deduct that as an expenditure. And of course, any bribes or receipt payment being made, we cannot be claiming as an expenditure. Then your entertainment expenditure is limited to 50%, and there are certain categories for which you can claim that entertainment expenditure. So these are with respect to customers, shareholders, suppliers, business partners. So any entertainment expenditure being incurred for them in the form of meals or accommodations or transportations or any kind of membership fees. If we pay, like if we are paying 100,000 in the year for your customers, for your shareholders, like owners, then up to 50% of 100,000 is 50,000. Only 50,000 will be allowed as a deductible expenditure. Beyond that, it won't be allowed as an expenditure. Then next category is pertaining to the interest on loan by related party. So a related party is like a shareholder who's or the owner who's funding the business, who's making the funds to the company. Then the interest earned on that will be only allowed with substance. That means it is for the business purposes. It is not for withdrawing any capital amount to invest in the funds. It is being used for the operation purpose, then it can be allowed. And then the transfer pricing concept will come into with respect to the interest amount, the rate of interest being charged in the company. And then certain penalties or fines being paid will not be allowed, as because these are for non-compliances with respect to any provision that will not be allowed as a deductible expenditure. And then dividend and profit distributions are not, because these are like out of profit, out of income being earned on the company. That dividend being distributed is not an expenditure. And then there is another critical position is regarding the interest amount. Interest up to 30% can be claimed, 30% of earning before interest, tax, depreciation, and allowances. So there's a limitation up to what the interest amount can be claimed is 30%. So if suppose if we have a the income is earned in a year is 100,000. EBITDA earning before interest, tax, and depreciation is 100,000, and then the interest component is 40,000. Bank interest paid is 40,000. So up to out of 100,000, 30% is 30,000, whereas interest earned is 40,000. But now there's an annual limit up to 12 million. So whichever is higher. So if it is more, even like you're earning, your in EBITDA was 30%, is 30% of 100,000 is 30,000. But since there's an annual limit of 12 million, so you can claim the full amount of 40,000 as your interest deductible expenditure. And it includes the various categories of interest amount. It could be with respect to the finance lease as well. It's not only the bank interest, but there's different other categories. Even the guarantee fees amount also can be considered as an interest component to be deductible as an expenditure. And then, of course, any kind of tax being paid will not be allowed as a deductible expenditure, because those are not an expenditure. It is a tax which is being paid to the authorities. And so to summarize in terms of what are those expenditures that, what are the points we need to take care of it is basically we need to see that we need to identify what are our exempt income, which are not taxable, because that will not be included in our tax purposes. And also any expenditure incurred with respect to those exempt income has to be identified separately. And also we need to keep a separate record for what are personal expenditure and what is the business expenditure, specifically when it is being owned by the shareholding is 100% owned by a particular owner. They need to identify that they are not claiming the personal expenditure in the business purpose. And then we need to have asset capitalization policies, because we cannot be claiming the expenditure incurred on buying an asset, but only depreciation is allowed. So we need to see for how many periods we will define that period of useful life of the asset to identify the depreciation amount. And we need to see the interest amount has to be calculated separately, that how much is claimable, how much is not. Similarly, the entertainment expenditure and any kind of input VAT we have to track separately so that we are claiming out of the output VAT. If we don't claim it, then we cannot be deducting expenditure. And any kind of penalties, donations that are incurred that need to be tracked. And any amount paid by the owners need to be recorded separately. So these are the provisions which we need to be careful, when we are. So the chart of accounts become critical, to track those expenditures so that we are able to claim only the one which are allowed deductible expenditures. So now, I have taken the points. Now, Balram will take over the next sessions with respect to the qualifying free zone. What are those areas which are considered for and business activities? So yes, Balram, handing it over to you.
Manish, can you stop sharing? Yeah. It's invisible. Yeah. Thank you, Manish, for taking us through this. So now let me just get into the important area of corporate tax is the free zones, corporate tax applicability for the free zone companies. So one important, we have many free zones here, and we have many entities and businesses which are conducting their businesses from free zones. So though the ministry has mentioned about all these points in the decree law, as well as they have released two decisions. One is cabinet decision as well as another one of a ministerial decision. But still there is a little confusion or clarity is not still there in terms of interpretation of some of the rules that they mentioned with respect to free zones. So here there are a few important things that we need to understand with respect to free zones. One is to see whether you will be considered to be qualifying as a qualifying free zone person or not. So what are the conditions that we need to fulfill to qualify as a qualifying free zone person or to get the status of a qualifying free zone person? And also equally important to understand what is qualifying income and what are the activities that are considered as qualifying activities and what are excluded activities. So these are the 3-4 concepts that are important from the point of view of free zones under corporate tax. So we'll try to understand a little bit more about those. We discussed this earlier, but we wanted to bring a little bit more clarity. The reason being that recently the FTA has released a public consultation document on free zones with respect to those two decisions that they've released. So in that form, they've given a little bit more details with respect to each of the activity and also given some examples and others. So we'll try to attempt to discuss those also as part of the session now. As I mentioned, so these are the conditions that are required to be complied with if any free zone company want to get the status of a qualifying free zone person. One important point they mentioned is the maintenance of adequate substance in the state. So you need to have the proper business being conducted from the free zone in order to get the condition, in order to get the status. If you have only license here without having the real business happening here, so the chances are that you may not get the status of qualifying free zone person. So, but before that, what is the importance of a qualifying free zone person? Why are we looking at this status is that any company which is a qualifying free zone person will get the benefit of 0% tax on their income. Otherwise, you may have to pay a 9% on your full income, or you may have to pay the taxes like any other mainland company, like 0% tax up to 375,000 dirham profit, 9% in excess of that profit. Okay, so if you get the status of qualifying free zone person, your income will be subject to tax at 0%. If not, then you may pay 9% or you may pay 0% up to 375,000 dirhams and 9% in excess of 375,000 dirhams. So that is the importance of getting the status of this qualifying free zone. person. So as I mentioned, first point is to have enough substance. The substance in the form of assets being here, in the form of employees being here, enough number of employees being here, and you as a business being spending enough amount of operating expenses to the size of your business. So substance is always relative to your size of the business and in the industry that your business is in. So if you are claiming to have 100,000 million as your turnover of your business in the free zone, so do you have enough amount of asset base to be able to conduct that size of business? And do you have enough number of employees in the free zone to be able to conduct that size of business? Same way, operating expenses, are you incurring to be able to do that size of business in the free zone? So this simply mentioned it is in the free zone. So we assume that it could be in that specific free zone where your company is established, or it could be in any other free zone, but running that business that you have in free zone, in other free zones. So as long as you are maintaining adequate substance in the free zone, then you will be considered as having met that particular condition. The second part that they mentioned is deriving the qualifying income. So you as a free zone company should be deriving a qualifying income. What is the qualifying income? That we will look into it in the future slides in more detail. This is one of the important area to understand where we have a lot of confusion, and clarity is required. Furthermore, clarity is expected from FTA also, even after this public consultation document being considered. The third point that they mentioned is to satisfy the de minimis requirement. Of course, it also is part of the qualifying income. We'll look into this de minimis requirement. This is not a separate condition as such, but this is an important point to look at. And the next point is the free zone company not electing to be subject to a corporate tax like a mainland company. Meaning, though you are a free zone company, but you may elect yourself to be subject to tax like a mainland company with normal rates like 0% tax up to 375,000 dirham profit, 9% in excess of that. If you elect, then you will not get the status. If you don't elect to be subject to tax like normal corporate tax rates, then you are assumed to be meeting this particular condition. Okay. The next point is that if you have any transactions with any of your related parties or connected persons, then you have to maintain or meet the requirements of the transfer pricing guidelines and maintain the transactions or have the transactions at arm's length. So this is another biggest area to be looked at to understand what is a related party and what are connected persons, and then how do we come up with this arm's length price. The last point is that the free zone company should maintain their books of accounts audited to get the status of qualifying free zone person. So these are the points that we need to, these are conditions that we need to comply with to get the status of qualifying free zone person. And the question is that if we don't meet any of these conditions, the requirement is that all these conditions should be met to get the status. If we don't meet any of these particular conditions, or if we fail to meet these conditions during the period, then we will lose the status of qualifying free zone person in that year. Not only in that year, even in the future 4 years along with this year, you will not be able to get the status again. So you need to recheck or constantly keep checking whether you're complying with these conditions or not to continue to get the status of qualifying free zone person. And in the point of substance, is you can also outsource your activities to someone else, as a third party or related party, as long as you have control on those activities. But these are the main points that we need to look at to get the status of qualifying free zone persons. So this is what I was just mentioning. The tax rates applicable in general, you know that it is 0% up to 375,000 dirhams, and 9% in excess of 375,000 dirham profit. But you are a qualifying free zone person. If you have qualifying income, then your income will be subject to tax at 9%. If you have non-qualifying income, then your income may be subject to tax at 9% straight, without getting any benefit of 375,000 dirham base limit. So which means even if you have 10 dirhams non-qualifying income, that 10 dirham related profit will be subject to tax at 9% straight. So that is the difference. So now let us quickly look at what is qualifying income and what is non-qualifying income. Qualifying income, they clearly mentioned that if you have any of these three, incomes, then you will be considered as having qualifying income. Subject to meeting the other conditions that we discussed in previous slides, then you may get the status of qualifying freezone person, whereby you will get the tax at 0% on your income. When I say income here, it is going to be profit. So first point they mentioned is that income from another freezone person, but those activities through which you get income should not be part of excluded activities. So we look into this activities list in the future slides. But yeah, you are a business in the free zone and your customers are going to be free zone persons. It could be in designated zone or any other free zones. Okay, as long as you have that and your activity is not an excluded activity. Okay, whatever activity you conduct is not an excluded activity and your customer base or your customers are only free zone persons. Then whatever income you get is going to be considered as qualifying income and that will be subject to tax at 0%. The second point here is that income from qualifying activities, it could be either from mainland or outside of UAE, except excluded activities. So now you are doing business and which is falling in the definition of qualifying activities. There's a list of qualifying activities, which we'll look at again in future slides. You are doing one of the activities mentioned in that list, in which case you can have your client base maybe from free zone, maybe from mainland, maybe from outside UAE, as long as those activities are not part of excluded activities. So here excluded activities is a kind of list of activities which attract corporate tax at 9% irrespective of your place of your business. Okay, as long as you are not conducting any activities part of the excluded activities list. And if you are conducting qualifying activities, you can do business with any person, be it in free zone customer or mainland customer or outside UAE customer. But if you are conducting any other activities which are not part of qualifying activities, at the same time they are not part of excluded activities, then if you have your customers only from free zones, then any income that you generate out of the business is going to be considered as qualifying income. The third point is that other income, not mentioned in above those 2 points, but you have that income being subject to de minimis threshold. De minimis threshold means we'll look into that also again, but this is a small portion of your business, okay? And that small portion could be from any source. It could be from any person. As long as that is within the limit of that de minimis threshold, then also it will be still considered as qualifying income along with other qualifying income. Okay? So de minimis here they are mentioned clearly that your non-qualifying revenue does not exceed 5% of total revenue or 5 million, whichever is lower. We'll look at that again in the future slide. So this is what is defined as qualifying income. If you have any of these incomes falling in your income and not having any other income, then you'll be called as having qualifying income, whereby you'll be getting the status of qualifying freezone person if you meet other conditions. Now let's look at the non-qualifying income. So as I mentioned, qualifying income subject to tax at 0%, non-qualifying income subject to tax at 9% without having any base of 375,000 dirham limit for 0% tax. So which means any amount you get out of this non-qualifying income will be subject to tax at 9% straight. When I say income here, it is the profit on those activities. So one is that revenue from immovable properties which are located in free zone, and those are leased out. Those properties are commercial properties and you're doing transaction with non-free zone person. Okay, you have commercial property in a free zone and you are leasing it out to a non-free zone person. Then it becomes non-qualifying income. You have an immovable property in a free zone and you are doing this transaction with any person, but that particular property is non-commercial property. Okay, this is a non-commercial property and given to any person, be it free zone person or non-free zone person. Okay, it becomes a non-qualifying income and that becomes subject to tax at 9% straight. So you have a immovable property in free zone and that is a commercial property and given to non-free zone person, it becomes non-qualifying activity. And that immovable property is given to any person when that immovable property is a non-commercial property. Okay. In all these instances, the income generated is considered as non-qualifying income and it will be subject to tax at 9%. The second part of it is that any revenue that you're generating out of your domestic permanent establishment or foreign permanent establishment, and then that income generated from those permanent establishments will be subject to tax at 9% again. So what do you mean by domestic permanent establishment here? You're a freezone company and you have a branch in mainland company. So this branch could be considered as a permanent establishment for this freezone company, as long as that branch is completely handled from your freezone, or you have a team which is sitting outside in the branch and managing that particular branch. So you are managing that particular branch from mainland, and this is a branch of a freezone company. So whatever income you generate out of this branch is generally considered as domestic permanent establishment. The income generated out of this is considered as a non-qualifying income, which will be subject to tax at 9%. Not only a branch, if you have your freezone company in any freezone, but you have an employee who's sitting in the mainland and operating that particular business. So any income that you generate out of this could be considered as domestic permanent establishment income. So you need to be really careful from where the company is being managed or controlled or managed and operated. Will it fall under domestic permanent establishment or not? And similarly, if you have any branch outside UAE for a freezone company, and that outside UAE establishment, which is called as foreign permanent establishment, income generated from that could be considered as non-qualifying income, and it could be taxable, taxed at 9%. So this is what is with respect to qualifying income and non-qualifying income. We'll look at the activities list in detail, but this is what we need to look at. As I mentioned, so this is a list of qualifying activities. If your business is conducting any of these activities, the possibilities of your business falling under qualifying free zone persons are high. So any business that is generating business income out of these activities, okay, and you could be doing your business with free zone companies or mainland companies or outside UAE companies. But the only criteria is that you should be doing one of these activities to get that benefit or status. Okay, so this is a list. We will look into this list in detail in the following slides, but just for your information, I kept them here. Just to read quickly: manufacturing of goods and material, processing of goods and material, distribution of imported goods or materials in or from a designated zone. So this is the only activity for which they clearly mentioned designated zone requirement, and rest of the activities do not have that designated zone reference, which means you can be doing your business these activities from either designated zone or non-designated zone, free zone. Okay, designated zone here is having the same definition and meaning as we know under VAT law. But however, they have not given what is the free zone list under Corporate Tax Act. So that list is also important to look at to see whether your free zone is part of that particular list given by the ministry, and then see whether this is called as a designated free zone or not. Okay. Yeah, so just to continue with respect to services, holding of shares and other securities, ownership, management and operation of ships, reinsurance services, fund management services, wealth and investment management services. These three services should be licensed appropriately, and they should be complying with the requirements of the regulatory authority with respect to those activities. You have headquarters services to related party, treasury and financing services to related parties, financing and leasing of aircraft, including engines and rotable components, logistics services, and any ancillary activity to the list mentioned above. Okay, so these should be your primary activity. Any ancillary activity to be able to conduct that activity could also be part of the qualifying activity, which should not be conducted on an independent basis. It should be part of your activity, main activity. So this is a list of activities called as qualifying activities. Now you see excluded activities, And if any of your company is conducting these excluded activities, you will not get the status of the qualifying freezone person. Either you'll be subject to tax at that 0%, like a normal mainland entity. Then you will not be able to get the status for next 4 years, not only this year, but next 4 years, in the first year plus next 4 years. So what are those activities? So transactions with natural persons. Freezone company is doing business with any natural person, then that could be considered as excluded activity, and your income will be subject to tax at regular corporate tax rates, and you will not get the status of qualifying freezone person. The only exception is that even though you do business with natural person, but if you conduct your activity is that of ownership or management of ships, and you're providing the service to natural person, or fund management services which you're providing to a natural person, wealth and investment management services, financing and leasing of aircrafts. So if these activities you do with natural persons also, you will still be considered as conducting qualifying activities. And any other business that you provide to natural persons will come under excluded activities. And the next activity is banking activities, insurance activities other than reinsurance activities, financing and leasing activities except financing to related parties, and financing to aircraft. Other than these two, any other financing and leasing activities will come under excluded activities. Transaction with another freezone person related to immovable property other than located in freezone. A freezone company is having property outside UAE, outside the freezone within mainland. Then that activity, or whatever income you generate out of that, will be considered as excluded activity, which means you'll be subject to tax at regular tax rates of 0% up to 375 and 9% in excess of 375,000 profit. There is profit. Intellectual property assets income. If you have any intellectual property and you get any income out of that, that will also be considered as excluded activity. We will look at this list in detail in the following slides. But to give the gist of it, so these are the activities that you have to look at. Qualifying activities on your left-hand side on the screen, and excluded activity on the right-hand side. So let us quickly look at these activities in detail. Now we are starting with qualifying activities. As we have seen, manufacturing of goods or materials is one of the qualifying activities. Now we have to understand what all do you include as part of manufacturing of goods. They say that manufacturing of goods include creation, production, improvement or assembly of products and materials from raw material or components into finished product or whatever you call it is. So any activity that you conduct with respect to the products or goods within a free zone will be considered as qualifying activity. Now this additional explanation that I'm giving here in the brackets is taken from the public consultation document, which is available in general on the website of the Ministry of Finance, also on FTA's website. So in this, what they have tried to do is that they try to explain a little bit more in detail with respect to the activities. They have also given the examples just to understand. But important point that we need to keep remembering is that this is only a public consultation document, and in no way it will be considered as part of the law. We need to wait and see until they come up with an amendment or additional guidance with respect to these explanation and examples that they have given, and then take decision on that basis. Okay, but as of now, it is a good material to understand. Most probably they may consider these most of the points and bring in as part of their further official releases. And the next point is processing of goods or materials. This, they said, it includes preparation, treatment, transformation, or conversion of goods or materials into another form for commercial or industrial use or resale purpose. Okay, so you're doing a process. A process could be including of any of these: preparation, treatment, transformation, or conversion of the goods, materials into another form for the purpose of commercial or industrial or resale purpose. Okay, so if you are doing this, then it is considered as part of processing of goods or material. The third point, one of the most important point, and the point where we had a lot of doubts, or a lot of instances could fall in or could not fall in the qualifying activity definition. distribution of imported goods or materials in or from a designated zone to a reseller. So distribution of imported goods or materials in or from a designated zone to reseller. So this, they said the further explanation of this is a distribution of goods or material includes the buying and selling of products, materials, component parts, or any other items that are tangible or movable, but not including financial assets and instruments in or from a designated zone. So we know the real or the normal understanding of distribution of goods. As part of that, we may buy and sell. It could be product, material, component parts, or any other item, but not they are not considering these financial assets or instruments. Other than this, any item that you buy or sell, that could be considered as a distributing activity, but it has to be done through designated zone only. Because this is the important point that we need to look at. The distributor should be based out in designated zone. But of course, there are certain other things that they have looked at, but we'll look at those examples in future slides. But yeah, the distribution is linked to a designated zone entity. The qualifying activity of distributing goods and materials may include functions such as importation, storage, inventory management, handling, transportation, and exportation of those goods and materials. So this could be done as part of your distribution activity. This cannot be your main activity to consider as a distribution activity, but this could be one of the activity as part of your distribution along with your buying and selling of goods. As I mentioned, distribution designated zones list is the same list that we have for VAT purpose. But one important thing to note is that free zone list is not out yet, which all free zones will be considered as free zones for corporate tax purpose. That is still not out yet. A designated zone list, we know what is there in the VAT law. So let us just quickly try to understand examples. I'm talking about manufacturing activity. So if you are a manufacturer, even for manufacturing activity also they mentioned two categories. One is contractor or contracting manufacturer. The other one is a regular manufacturer, or it is called as fully fledged manufacturer. Okay, so these are the two types of manufacturers that they have mentioned in the public consultation document. You are a manufacturing company and you could be in free zone or in designated zone. But you are doing this manufacturing activity for some other suppliers. Okay, you are only conducting that. So then the qualifying income, whatever you get out of this particular business, your contractors, your customers could be a free zone company or a mainland company. Okay, or it could be a foreign company. So any customers you have, but as long as you are doing this manufacturing activity for someone else, you're only a contractor, you are only a manufacturer, then whatever goods you sell out of the manufacturing activity becomes your qualifying income, and then you could be considered or get the status of qualifying free zone person. So this is another set of examples. So this they are referring to the fully fledged manufacturing activity. You are a manufacturer in a free zone, and you are manufacturing your own products. Okay, which means they are named of your own company, and they will be marketed or sold in the same name of your company. So the brand is yours, and you're manufacturing your products. Okay, so here we have various scenarios, like you may have your distribution, your manufacturing facility in designated zone. Then how is it going to be treated? Or you have your manufacturing facility in non-designated free zone, then how is it going to be? Okay, so based on your manufacturing facility being located, the applicability of this rule may vary. So let us take the first scenario which is mentioned on the top. For a manufacturing company which is located in a free zone, and you're manufacturing your own branded products, and you're selling it to a mainland entity or a foreign entity. Okay, if that is the case, if you're only conducting manufacturing activity and you're not doing distribution activity, then your entire income will be considered as qualifying income. But in addition to your manufacturing activity, you're also conducting distribution activity, which means you're distributing your products from that facility in the free zone to any other free zone, or maybe to mainland, or to mainland, basically to mainland of foreign entities. In that case, if that distribution activity also complies with the distribution activity requirements or conditions, then that will be subject to zero rated tax, which will not be the case in general. So you are a non-free zone company, your facility is, the manufacturing facility is in non-designated free zone. If you're doing only manufacturing activity, no problem, you can supply to any company, mainland or foreign. That income will be considered as qualifying income. But if you're also conducting the distribution activity along with manufacturing activity or any other activity which is not qualifying activity, so then that becomes non-qualifying income. Okay. If you're only doing manufacturing activity, then that income will be considered as qualifying income. Now let us look at the second scenario where your manufacturing facility is in designated zone. Okay, and you are doing manufacturing your own brand products, then your manufacturing activity income will be considered as qualifying income. Your distribution activity income also, if you're doing distribution as well, that also will become considered as qualifying income. The main difference is that your facility and your company is located in designated zone. If you're in designated zone, you're conducting manufacturing activity, then any activity that you do, either manufacturing or manufacturing and distribution, and your service or customer base can be in mainland or in free zone, then entire income will be considered as qualifying income. And the third scenario that they've given is that your manufacturing facility may be either in free zone or in designated zone. Okay, you are conducting qualifying income, which means manufacturing activity. You could also be doing distribution activity, but your customer base is only in free zone. So if your customer base is only in free zone, any income that you generate out of your manufacturing activity or distribution activity and could be considered as qualifying income. Okay, so here the important thing to note is that whether your manufacturing facility is in designated zone or is in free zone, are you conducting only manufacturing activity, or are you also conducting distribution activity along with manufacturing activity or not? Based on that, your income will be classified as either qualifying income or non-qualifying income. But if you have qualifying income and non-qualifying income, you need to maintain a separate tracking of your both activities related transactions and income, and then see whether you have non-qualifying income. If this non-qualifying income is less than your de minimis, then it could also be considered as part of your qualifying income, and then you may get the status again. Okay, so this is with respect to manufacturing activity. When you are in order, you are a fully fledged manufacturer. And distribution activity. So this is third activity that I mentioned. Distribution activity, they've clearly given another example wherein here designated free zone person, which is considered a distributor company, buys goods from a manufacturer in country A and sells those goods to a retailer or distributor in country B. Okay. So you are a designated free zone company in UAE and you are buying your goods from from a country A, a manufacturer, and you are selling that goods to a retailer in country B. Okay, distributor company earns profit out of or margin on these goods sold to the retailer in country B. The goods are shipped directly from manufacturer in country A to the retailer in country B. So you are buying from, let us say, from India, and you are supplying it to let us say Singapore. Okay, so you are a free zone company located or registered in a designated zone in UAE. You're buying goods from a manufacturer in India and supplying them to a retailer in Singapore. So they clearly mentioned that it is retailer or distributor. Okay, it should not be an end user, your customer. So in this case, in the PCD, they mentioned that whatever income that you generate, though the goods are not coming to designated zone in UAE and going out to Singapore, the income that you generate out of this still may be considered as qualifying income. So it is, you need to remember that this is mentioned in the public consultation document. This is not still mentioned in the law yet or in the form of guidance. So this is only PCD, but they're trying to give a little bit more clarity or try to include some of the activities which could be considered as qualifying activities. If you read the law as of now, the plain reading of the law which is available in English, in which case this example or case study may not fall under qualifying income, qualifying activity. But as part of this PCD, they included this and they also mentioned this as qualifying income. So we have to see whether they really want to take this as qualifying activity in future further guidances and then come up with an amendment or whatever. But at the moment in PCD they mentioned this. Okay. Another example of distribution of goods or materials within UAE. So now we are talking about within UAE. So you are a distributor sitting in a designated zone and you are buying the goods from outside UAE, from country A, from a manufacturer, and you are selling those goods to a retailer or distributor within UAE mainland. Okay, so that UAE mainland entity is not an end user, but they are only a retailer or a distributor. Okay, if that is the case, and if your goods are coming from outside UAE, they are passing through designated zone, and you are supplying them out to the mainland entity, then whatever income you generate out of this could also be considered as qualifying income according to public consultation document, PCD. Okay, so this is another example they have included, which I think was also being considered as plain reading of the law earlier as well. So there's no confusion with respect to this. So far we discussed about the activities related to goods. Now we are looking at activities related to services. Holding of shares and other securities could also be a qualifying activity. What is holding of shares? Holding by way of investment or as security, shares, stocks, debentures, and other securities or other assets or rights for the sole purpose of issuing securities or other financial instruments that directly or indirectly represent an interest in the economic risk and benefits associated with these assets or rights. So basically the regular securities and shares. Also they included debentures and other form of securities. Okay, if you are a company which is holding these, income generated out of this could be qualifying activity or qualifying income. Next point is ownership, management or operation of ships. This includes ownership, management and operation of ships used in the international transportation of goods or persons, including the management of crew of a ship and leasing and chartering of ships on a bareboat basis. Okay, so as long as you are doing these activities and that ship is used in international or for international transportation of goods or persons, then that activity could be considered as qualifying activity. Reinsurance activity, which was in fund management services, if you're providing these fund management services to your customers, or wealth and investment management services to customers, all this could be considered as part of your qualifying activities. Further qualifying activities under services like headquarter services to related parties. You are a freezone company and you are providing these headquarter services to your related parties. Then whatever income, this activity is a qualifying income activity. Income generated out of this could be considered as qualifying income. What is headquarter services? Headquarter services includes the administering, overseeing and managing of business activities of related parties, including the provision of senior and general management, captive insurance services, administrative services, business planning and development, risk management, coordination of group activities, procurement, and in general, incurring expenditure on behalf of related parties and providing other support services to related parties. If you provide any of these activities, then that activity could be considered as headquarter services to related parties. This activity should be provided only to related parties. Only then it will be considered as part of this particular qualifying activity. We have a lot of companies which generally have their headquarter or they have their base in freezone. and they do coordinate for their related parties from outside UAE. Those related parties could be in mainland or in free zone. Okay, so all those activities will be considered as qualifying activities. Treasury and financial services to related parties. Again, related parties here. This point also. What is treasury and financial services? It includes the intra-group financing, and treasury services include the provision of cash and liquidity management, financing, debt management, and financial risk management, and related advisory services to related parties. They are also included advisory services, including centralized payment and collection activities for or on behalf of related parties. Okay, if you're doing these activities for your related party, being a freezone company, that activity could be considered as qualifying activity. Next point is financing and leasing of aircraft, including engines and rotable components. That also is a qualifying activity. Logistics services, you are a freezone company and you are providing logistics services. That could be a qualifying activity. What is logistics services? Logistics services includes the storage and transportation of goods or materials on behalf of another person without taking title to the goods or material of that other person, including cargo handling, warehousing, container storage, transport agency services, customs brokerage services, order and inventory management services, freight forwarding and brokerage services, document preparation, packing and unpacking, and other related services. So all these services, if you're providing, not taking the possession, the title of the goods, and you're only providing the service, then all those activities could be falling under logistic services, and they become qualifying activities. Any other ancillary activity to the mentioned list above also is a qualifying activity that we have seen. Okay, so far we have discussed in detail with respect to the qualifying activities. So just to remind you, what is the importance of qualifying activities is that you are a freezone company, you are conducting a qualifying activities, then your customer base can be at the mainland, free zone, or outside UAE. As long as those are not part of excluding activities, your income will be considered as qualifying income, and then you may get the status of this qualifying free zone person if you meet other conditions. So this is a list of safe activities from corporate tax point of view. Now this list is a bit of negative list of activities. If you do any of these activities, then you may not get the status of this corporate qualifying free zone person, and your income could be subject to tax at normal rates. Transaction with natural person that we have seen, what are not included. Banking, insurance activities that we have seen, financing and leasing activities, etc. Those two activities we have seen. Here, one thing I wanted to highlight is that what is intellectual property asset income? They said the ownership or exploitation of intellectual property assets means activities that generate separately identifiable income from intellectual property assets that are owned and legally protected. For example, trademarks, patents, copyrights, brands, and technical know-how. Okay, so you have any of these assets, they are recognized in your books as asset, and you are able to generate identifiable income out of those assets by way of exploitation or by way of any other means. Okay, first thing is that you should be having an intellectual property asset, and you're able to generate income out of those intellectual property assets which are identifiable separately. Then that activity becomes intellectual property asset related activity, and it may fall under exclude activities. So if you do that, then you will not get the status of this qualifying person activity. But whereas you have IP asset and you're not generating separately identifiable income from that particular asset, but this asset is used as part of your main business activity. Okay, so the software is used as part of your main product. That product is a regular product. Then that activity will not fall under this intellectual property asset income activity, and it could then be considered as part of your qualifying activity. So far we discussed all this qualifying activities and exclude activities, as well as the definition of qualifying income. As part of the qualifying income, we have seen that as a third point, let me just take you through that. So yeah, so this list we have seen, so this definition we have seen. So as I mentioned, qualifying income, we have income from any free zone person. The activity is not excluded activity. Income from qualifying activity, and that activity is not excluded activity, but that could be from mainland or outside UAE customers. Third point is that other income, other than these two, which is subject to de minimis. So now we are looking at this de minimis threshold. I've also explained already, but I'm just trying to explain it in detail with this. Okay, so the de minimis threshold is nothing but non-qualifying revenue. Means your revenue is not part of that qualifying list. And that list, that income is less than this de minimis threshold. The de minimis threshold is either 5% of your total revenue or 5 million dirhams, whichever is less. And whichever is less becomes your de minimis threshold. And your non-qualifying income is less than this particular amount, then you are still be considered as having qualifying income. Okay. There's one point to note here is that for considering or calculating total revenue, you will be excluding these income that you generate from these activities. Okay. So de minimis, I just now presented it in a pictorial format. You have a qualifying activity which is of this size, and you have non-qualifying income activity, which is minimal as long as it is below your de minimis threshold. So this is the scenario, your income still could be considered as qualifying income. So then it is a different way of presenting how to understand the applicability of taxes to free zone persons. I will quickly run through, but yeah, you can look at it later on at your ease. So you are a free zone person, and your source of income is coming from a non-free zone person. Means your customer base is a non-free zone person, and you have qualifying activities. So your business is qualifying activity business, and your customer base is non-free zone persons. Since you are conducting qualifying activity, and that is not part of excluded activities, your income will be subject to tax at 0%. Similarly, you are a free zone company, and your customer base is non-free zone person, and you are generating your activities are not part of qualifying activities. Then we have to see whether your income from these non-qualifying activities, is it exceeding a de minimis threshold? If it is not exceeding, which is within your de minimis threshold, and this income still could be considered as qualifying income. But whereas your non-qualifying activity income generated out of your non-free zone persons is exceeding the minimum threshold, then you will lose the status of qualifying free zone person. This is how we understand. Similarly, you are a free zone company, and your customers are also free zone persons. Then you are conducting a non-excluded activity. Okay. Any activity that you do, as long as that is not part of excluded activity, then your income will be subject to tax of 0%. But let's say you are as a free zone person providing a business with doing business with free zone person, and you are also conducting excluded activities. Now we have to see whether this income from excluded activities, is it more than the minimum threshold or less. If it is less than the minimum threshold, then fine, that will be still considered as qualifying income, and you will get the benefit of 0% tax on total income. If not, then you lose the status of qualifying free zone person. So this is how you have to understand. And you have, but if you have domestic or foreign free zone permanent establishment, your entire income from that particular domestic or foreign permanent establishment will be subject to tax at 9%. Let's say you are a free zone company, you have immovable property located in free zones, and that is a commercial free zone property and given to a free zone person. It is subject to tax at 0%. that immovable property is a commercial property and it is given to a non-freezone person, then it will be subject to tax at 9%. You have a immovable property located in free zone, and that is non-commercial property, and then to whomever you give it, it will be subject to tax at 9%. So this is what is the classification. So any business which is in free zone could fall in any of these things. Either you may be falling in this category or you may be falling in this category. How do you determine your taxable status for a free zone person? Which we just try to look at this, like, you have to know your own business. What kind of activity do you conduct? Whether those activities are falling under qualifying activities, or they're falling under not excluded activities, or do they fall under any other activities, non-excluded activities? Then you also need to look at your customer base. So what kind of clients do you have? Do you have clients which are located in free zones? Or do you have clients in free zone and outside? Maybe in mainland, maybe in outside UAE. Then you have to look at your activity, as I mentioned. So, first step you look at whether you are a free zone company or not, and second you look at your customer base, and third step you look at your activity. What kind of activity are you conducting? Is it part of your qualifying activities or other activities, and so on? Once you know these three things, then you will be able to decide whether your tax will be subject to 0% or others. This is how we generally determine. These are various scenarios that we have just plotted. We will share this as part of your presentation for you to look at it. But so you're a supplier which is in designated free zone, and you have customer in designated free zone again. As long as you are conducting non-excluded activities, then your income will be subject to tax at 0%. This is how we have to read it. Okay, so there are some exceptions, but yeah, so by considering the time constraint, we will just move ahead. And this is also another set of activities or scenarios that you can look at. This is if you are a company which is in free zones. Okay, then what could be your scenario based on your customer base as well as activity? What will be the impact or applicability of corporate tax rates? So we are done with our free zone persons related slides. Now we are looking at a few other important slides or concepts. One important thing is small business relief. They mentioned in the decree law, and they also released a cabinet decision on this particular activity. So if you are a business which is having turnover of less than 3 million or less than 3 million, then you could be considered as a small business relief when you apply for it. So what is the benefit of this free zone, small business relief? If you are a small business person considered for corporate tax purpose and you are electing for that, then your entire profit will be subject to tax, or you will not be subject to tax at all in that year. The tax payable by you will be nil. Okay. So, but there are a few other conditions to meet, like you should be having this revenue of 3 million or less in the first year, and if you have to continue to have this small business relief in future years also, in any of these future years, you should not be having a revenue more than 3 million dirhams. Okay, so in all the years that you want to enjoy the benefit of this small business relief, in every year, all the years, you should have revenue less than 3 million dirhams. And let's say that in 2024, your business has got 2.5 million dirhams. You can apply for the small business relief. In 24, you'll get that relief and you will not pay any tax in this year. Let's say in 2025, next year, your business has made a revenue of 4 million. So we know that it should be less than 3 million. So in this 2025, you will lose the status. You will not be able to apply for the small business relief. In 24, you already claimed and you did not pay any tax. In 25, since your revenue is more than 3 million, then you will not get this status, or you will not be able to apply for the small business relief. After that year, like in 2026, you have a revenue of 2 million. Okay, In third year, you have a revenue of 2 million. But since you had revenue of 4 million in second year, which is 2025, so in the following years, in that year, in the following years, irrespective of your turnover, you will not be able to apply for the small business relief. In third year, we had a revenue of 2 million, but since you had 4 million revenue in second year, so you'll not be able to apply for the small business relief in third year and henceforth. And this relief is given as of now till 31 December 2026, which means maybe for 3 years from the time the corporate tax is applicable for your business. It is starting from this year or next year. Okay, so this is what you have to remember about that. How do you arrive to your revenue? Your revenue should be arrived based on the IFRS requirements. Okay, you have to comply with the IFRS. This is what is referred in the law and decision numbers. At the same time, so once you are applying for the small business relief, you will not be expected to comply with these things like, you will not be looking at your exempted income. You will not be looking at your deductions. You will not be able to make any adjustments towards deductions. And you need not to comply with the transfer pricing documentation requirements. Not only that, if you have any loss in those years in which you claim for small business relief, if you happen to have any loss, that loss cannot be carried forward and adjusted against future profits. Your loss will be gone in that year itself. You will not get any benefit out of that in future years. So another area we quickly wanted to touch base is on related parties and connected persons payments. We have, yeah. So quickly, let me tell you what is related party. Related party is you as a owner of a company is having 50% or more in another company, in the company, or you have control of more than 50% of this company. So you as a owner and this company become related parties. That's one. And you have a company A and you have company B. So company A is investing in company B, and that is more than 50% of the capital. Then these two companies become related parties. Not only this, if company B invests in company C and that investment is more than 50% of company C's capital, then all these companies, company A, B, and C, all together become related parties. Not only through investment, through control also if we have, then also it will be considered as having related party relationship. Okay, so that's one. Connected persons definitions we see in the following slides. So what is the importance of this? If you have any business that you do with your related parties, then you are expected to comply with certain additional requirements, which are nothing but transfer pricing rules compliance. Okay, so we'll just quickly touch base on this. You could have any kind of transactions with your related parties. So the list of transactions are listed on here. So maybe like services, which could be, your company A is providing IT services to your company B. These two are related parties, and this transaction that you do with this could be, falling under this category of transactions. You may be purchasing or sales goods from related parties. You may be passing on or transferring your properties or tangible properties to your related parties. You may be arranging financing or funding arrangement to other related party or group, intergroup transactions, loans, guarantees. All those, if you're doing with your related parties, will fall under this category of transactions. Intangible properties, maybe you are getting priority or license fees from your related party. That also falls under this category. Capital transactions, issue, investment, or transfer of any shares or any other forms. Intra-group services, you may have your centralized services for accounts or finance. This may provide the service to your group companies. So these transactions will be falling under related party transactions. Domestic transactions are like, you have mainland entity and you have freezone entity, and freezone person is doing some business with mainland entity. They are related, then they become related party transaction. Connected persons, whatever payments you make to connected persons from company becomes related, and that should be looked at from the point of view of transfer pricing guidelines. Connected person definition, as I mentioned, a owner of a company and their relatives, a director or officer who is responsible person of a company and their relatives. All those become related parties or connected persons to the company. Any payments made to this list should be falling under the transfer pricing guidelines. and you need to make sure that the transactions are dealt with at market rate, market price. So what is your related parties definition? To what extent you can consider? So they mentioned the fourth degree of kinship is what they look at. So you are a owner, and you become connected persons to the company. Not only you, but your relatives, like 4 degrees or 4 generations above and 4 generations below. All those become related parties to you, and all of them become connected persons to your company. So what kind of payments you could be doing with your connected persons? One important point I wanted to highlight here is that the owners may take salary, the directors may take salary, or the officers may take salary. Or these owners, directors, or officers may give properties on rent to the companies, and companies may make the payment of rent. Or they may give perquisites, or they may, the owners and these connected persons may give loans to the company. The company may be paying interest on those loans. All this kind of arrangement and transactions could fall under this payments to connected persons, and in which case you have to make sure that that payment to this connected persons is at arm's length, or is it market rate. If someone else who is not connected to the person provide the same service to your company, how much salary would you pay? So that is what is precisely considered as market value. Of course, there are various methods to compute that, and various databases are available to do that. And we have expert team who can do the benchmarking and then comply with transfer pricing, or help you in complying with transfer pricing requirements by way of benchmarking, by way of creating policies for your company for TPs and others. But yeah, the important point here to notice here is that any payments you make to these owners, directors, and their related parties, you have to be careful whether these transactions are dealt with at market rate or not. So let's quickly look at this last leg of the session, CT administration. Who all are expected to register? Everyone except the people who are specifically mentioned not to be registered. Everyone else should be registered. Registration is online available, and it can be, there's no minimum threshold mentioned, irrespective whether you have revenue or not. As long as you have a company, it should be registered. It can be, there's no deadline or timeline given. The last date that it is given or expected to have the registration is that before you file your first corporate tax return, you should be registered. That's what is the expectation. But of course, if you do it now, it is going to be easier. Over a period, it may become complicated, or the requirements could be higher. Corporate tax return filing, it should be done once in a year. It can be done within 9 months from the end of your financial year. There is no advance tax returns to be filed. The payment should also be done along with your corporate tax return to be filed. And the due date for payment as well is within 9 months from the end of the financial year. It can be done online through electronically, like through your UAE tax portal. This is how the form could look like, the corporate tax return form. Here, one important thing to note is that your computation will begin by taking your profit as per books of accounts as base. So you will take the profit as per books of accounts, and to that you make adjustments. You may have exempted income, which is already included in your profit. That you have to eliminate if or exclude if it is exempt income. Likewise, you may have other expenses which you've already debited your profit and loss account, but some of those expenses are not eligible to be deducted for corporate tax purpose. Those expenses you need to add back to your profit. Likewise, adjustments will be done. All the adjustments which are like foreign tax credit, tax loss, and tax reliefs that you have, all those will be computed. And then finally, you'll come off after adjusting to your income, you'll come with the taxable income, and you'll compute tax. And then from there, you will be adjusting your withholding tax, foreign tax credit, and reliefs. If you have tax loss relief and all those things, then you'll end up with the net tax payable amount. This is only a base template that we derive, but yeah, the real actual template could be different. Along with this, you may also expect to be submitting the disclosure form, similar to disclosure form if you have any transactions with your related parties or connected persons. Record keeping, you're expected to have your books of accounts maintained for at least 7 years after the end of the financial year, effectively 8 years. All the persons who are taxable persons should maintain their books of accounts. And audit is mandatory if your turnover is more than 50 million dirhams. It is also mandatory if you want to be a qualifying prison person. Others, they may maintain their books audited. But yeah, FTA is interested in making these as mandatory. They may ask you to provide the audited report even if you're not part of this list. If you are part of any group, you have to maintain books of accounts separately for individual entity as well. There are certain other practical issues that you may end up with if you don't maintain books of accounts separately for each of the entity, though you are having a tax group. But for corporate tax purpose, you will be submitting your returns for the group as a whole, one consolidated tax return. But still, you need to maintain books of accounts separately by an individual entity. And generally, we go by accrual method of accounting, but the FTA has given, or ministry has given a relaxation. If you're a small business which does not have revenue more than 3 million dirhams, you can still continue to have your cash basis of accounting. And under any exception circumstances, you can also be, giving the benefit of the method of a cash basis, but for which you have to apply with FTA, and upon their approval, you can do that. We generally follow IFRS, but if your turnover is less than 50 million dirhams, you can also apply IFRS for SMEs, small and medium sized enterprises. So there are certain standards which may not be applicable to your company if you are falling under this IFRS for SME. Okay, so this is what it is about cash basis accounting. Transitional rules. The important thing to look at is that your closing balances for the first year or closing balances of previous year, rather. The opening balances for your first year of corporate tax applicability, you should make sure that they are clean, they are updated properly, you don't have any excess amount or less amount, it is updated properly. And if you have transactions with related parties, a balance is payable to related parties. So that should be as if already your transfer pricing rules have been applied to them. How would it be? So that, like that, you have to update the numbers and then keep them ready. So your opening balances for your tax period should be clean and been compliant with the rules or requirements already if you have any transactions with related parties. You have to be careful that you have anti-abusive rules or general anti-abusive rules as part of your tax planning and other changes that you make to your business structure. You need to make sure that you have a commercial reason, a valid commercial reason attached to it. Then only you can do it. If not, then any transaction or arrangement that you do, if it falls under the GAR. When I say GAR, so if your transaction or changing your structure or changing your whatever business that you do with the sole objective of minimizing or avoiding corporate tax with not having any commercial reason attached to it, then that transaction or arrangement could be considered as falling under GAR. The impact of that is that though you made this transaction or structural change, the FTA can ask you to remove the impact of that structural change and include that as if that change has not happened, and regular your assessment will be done as a regular normal assessment, which means that change in your structure will not have any impact. So that will be removed, and the entire amount will be considered as taxable without having that impact of change in the structure. So you need to be very careful while doing any changes to your structure or making any business the tax planning. The assessment, we can do a high-level assessment if you want us to do your business, any assessment for corporate tax purpose or transfer pricing point of view. And this high-level impact assessment can be done in detail once you agree with that. And the detail will be like each and every transaction will be looked at, and group structure, your business structure, all those will be looked at. And then we will prepare that for implementation. Changes will be done on all those things in step 3. And post implementation also we do take care of your returns filing, and if you start any particular new venture, and then how will that be done? What is the best way to do it? So all this kind of planning can also be done. So these are a few things that I wanted to cover as part of this session. We hope we added some value to your understanding of the corporate tax law. And if you have any other questions, definitely you can drop in mails. This is our mail ID to drop in. or you can also see our phone number to reach out to. Okay. But I will try and take up some questions. I think we have about 10 minutes time now. We'll try to see if we have any things to address. But yes, you can always reach out to us for this. As I mentioned initially, we do audit, accounting, and taxation services. Along with that, we also do company setup, business formation, and structure advice when you want to get into business, either here or outside. Plus, we also do risk management services. So these are the various services that we provide. And yeah, I have Manish also joining us if you have any questions to answer. Free zone companies will be considered as free zone companies. Mainland Freezone is not a free zone. Area is so yeah. So I think you are trying to ask whether the Mainland Freezone is a free zone or not. As I mentioned in my discussion, the corporate tax free zones list, they have not released yet. They mentioned that it will be released through a cabinet decision, but it is not released yet. As of now, the Mainland Freezone is considered as a free zone, but for corporate tax purpose, we need to wait to see whether it will be part of that list or not. The question I see is that if mainland or free zone company buy goods from Korea and sell to China, then do we need to pay tax in UAE at 9%, assuming company income is more than 375,000 dirhams? So if a mainland company or free zone company buy goods from Korea and sell to China, so you're saying third port shipment you're doing for mainland companies, of course, it is going to be subject to tax irrespective of whatever you do. All your profits will be subject to tax here at 9% if the profit exceeds 375,000 dirhams. But if you are a free zone company, then again we need to look at that whether this comes under distribution. We need to look at if you are part of a designated free zone or not. If you are part of designated free zone, then that could fall under distribution activity and may come under qualifying activities. But as I mentioned in the plain reading of the law as of now, this may not fall under the qualifying activities. The reason being the goods are not coming in to designated zone. They clearly mentioned that you will be doing this business by having the goods either in or from, which they intend to say that the goods should be moved from designated zone. In your example, since you're buying from Korea and selling it to China, and goods are not coming to UAE or designated zone, so it may not fall under qualifying activities. But in the public consultation document they released recently, which is still not part of your law, in that they have given this example and they mentioned that this could be a qualifying activity and may be subject to tax at 0% if you meet other conditions. So this, I would say that it is still not safe to answer fully that will it fall under 9% or will it fall under 0%. As of now, based on the law that we have, 9% is what is going to be applicable, even if you are a company established in designated zone. But this may change and may be considered as 0% taxability company activity. If you are a mainland company, it is going to be subject to tax at normal rates of 0% up to 375,000 dirhams, 9% in excess of that. I see there are transactions between two free zone companies taxable. Yeah, as long as you conduct activities which are not part of excluded activities, transactions between two free zone companies will not be taxable. So it's in the hands of the company which is generating income or getting income out of that particular transaction. So that business, if they have only business, we need to look at the overall business, not only one transaction, but entire business. Do you have only customers in free zone? And is my activity not part of excluded activity? Then your entire business will be subject to tax at 0%. But you have some transactions which you do with mainland, with your free zone companies. You also have some transactions with mainland entities. Then you have to look at whether these activities that you do with mainland entities, do they fall under qualifying activities? And that is not part of your excluded activities, then you could still be taxed at 0%. So it's not just one transaction, but it is your total business that you do should be looked at. And your total customer base is what you have to look at. And You have qualifying income, well and good. You have other income which is not part of qualifying income, and that other income is less than de minimis threshold, then also it is fine. Changing of financial year, a company changed the financial year on memorandum. How will this affect the tax return period? Do you want to answer that?
Yeah. So with respect to the change in tax financial period, you can do that. But need to be justified with a commercial reason that why that financial period is getting changed, and it has to be done before the filing of tax return. At least 6 months ahead of filing the tax return. And yes, when you change the tax financial period, then your tax, of course, will be considered from the period your financial period is. Like if you have period of like maybe you have current period is 1st October till September, 1st October 23 to September 24, and you want to change to 1st January to December 24, then yes, you can do it, and then your tax computation will be from tax will be considered for the income generated from January 24 to December 24. And a resolution has to be passed, and accordingly it has to be updated in the trade license as well. The memorandum also need to be updated for that.
What the difference in tax regime for free zones and mainland impact my current operating model? If my organization is incorporated in a free zone entity, for example, is it conducting its operations in line with the free zone regulations, and it will maintain its tax-free status or not? I think again we just need to look at all your businesses from the point of view of corporate tax and free zone related rules that we discussed so far, and then decide. Just by having a company in free zone will not give you the status of qualifying free zone person. You have to look at it whether really you are conducting those activities, whether your client base is also falling under the category that they mentioned or not. Based on that only, you will get the status of qualifying free zone person, and then your income will be subject to tax at 0%. Otherwise, it will not be subject to tax at 0%, but will be taxed at 0% or 9%, like a mainland entity.
I see a question like, what is the difference between a small business relief and a free zone special status? I think that's basically a small business relief is a relief given to the mainland companies or mainland businesses up to 3 million, their revenue. Whereas free zone special status is basically based on the business activities they are carrying out in free zone. It could be qualifying free zone, or it could be a non-qualifying or normal free zone. So that difference is based on the nature of the activities being carried out. Yeah. And there's one question which is a company liquidated in the middle of the financial year liable to file at corporate tax return? Yes, I mean, if the company is liquidated, suppose in the month of June 24, so the income from the period of 1st January till 30th June, or whatever the period of liquidation is, that income has to be calculated for that period, and the tax liability, whatever arises in between, that period has to be paid, and return has to be also filed for that.
Yeah. So I see one question here. Salary to owners and industry standard is very subjective. Are there any definitive limits? If we have family-run service businesses and have been withdrawn most revenue as salaries to members, virtually leaving no profits to be taxed. So this is very important to look at for most of the businesses. See, subjective means yes, it is subjective, definitely. The salary paid to the owners, directors, and their relatives. There is no limit given as such for most of the businesses, unless you are a public joint stock company, wherein they mention 10% of the profit as the maximum limit. But other than those public joint stock companies, generally, there is no limit given in the law for salaries to be paid to the owners, directors, and their relatives. But yeah, the challenge is that, yeah, as you mentioned there in the question itself, that some of the business owners, they withdraw significant portion of the profit, leaving no margin or no amount as part of the profit. So here the important point to look at is that the salary or remuneration that you take from the business, is it at market value to the services that you provide to the company or not? As I mentioned, if you appoint someone else in your role to provide the same services as whatever you are providing to the company, how much would you pay to that particular person as a salary? Okay, so that could be your market value. However, that's not the only element that we need to look at. In addition to that, after making this adjustment of market rate range, how much profit are you offering to the tax authorities to be taxed? Is it in line with the industry ratio of percentage of profit or not? Let us say that you are into technology industry and you are providing or developing a softwares. And now we have to see in the industry of your technology or software development of your size in the region, how much profit generally are they offering? What is the percentage of profit are they offering for taxation? Is your percentage also in that line or not? So you have to adjust your remuneration by considering the market rate. After doing that, also you will still look at the percentage of profit that you're offering for taxation purpose. Is it in line with the industry rate or not? So in two ways, or in both ways, you have to look at it and then decide whatever salary remuneration of payments that you make into the owners is at arm's length or not. So that's how detailed you have to look at it. It cannot be arrived or calculated simply by looking at one or two bases. It requires a lot of points to consider, the indicators to consider to arrive to that particular market value, and then comfortably say that yes, this is at market value or not. So we have a expert team who can work on that by considering various elements into it, and that will be useful or can be used whenever the FTA comes back to you to demonstrate whether the payments to the owners are at market rate or not. Investments in companies, as long as they are resident companies here, whatever dividend you get out of that particular investment is exempted income. And if you are investing outside UAE, then there is a limit on that. If you have a participating interest, in which case you'll get the exemption, otherwise it will be subject to tax.
Just adding on to that, in dividend which is earned out of UAE by a participating interest, where you need to hold more than 5% stake in the business outside UAE, and that has to be holded for more than 12 months period. And you get exemption of that income only when this other country is, in which your investment you're holding is also have a 9%, minimum 9% taxability rate. So when you have more than 9%, then only you are eligible to get an exemption in UAE for the portion of tax outside UAE.
I see a question from Iman. A non-designated free zone holding company get investment from UAE entities investing in Europe, where the revenue is taxed higher than 9%. So generally, you are an investor and you will get a dividend from outside UAE. Okay. So the dividends will be subject to tax at 9% only if you are not meeting that participating interest criteria. If you meet that participating interest criteria, then that could be, the dividend could be exempted income. And at the same time, if you happen to pay tax, you have a subsidiary outside UAE, and that is subject to tax outside UAE because it is an independent entity. And at the same time, that subsidiary or branch is effectively being managed from UAE, under which you are including that particular income in total into your UAE taxable income also. So if that happens, you being the owner or investor of that company, if you are including that total amount into your business profit, then you can take the credit of that particular tax that you already paid outside UAE. And that could be, if that rate is higher than 9%, then maximum to the extent of 9% can be taken as credit in UAE, and the balance amount of the tax amount only will be paid. Okay. I think we tried to cover more or less all the questions. If you still have any questions, you can definitely drop in your mail to our mail ID, which is info@spectrumaccounts.com, or you can call us on our landline number. Just for your benefit, I'm just sharing it. So these are the details. You can drop into us anytime. And thank you very much, all of you who have joined. And we see you soon. Thank you.
Thank you all.